Hello everybody, my name is Peter Petrov, and today I'll be presenting the financial statement disclosure and computing of the effective tax rate. This is for Business Tax Accounting 251, and today's date is October 7th. Today we'll be talking about the balance sheet classification, the income tax footnote disclosure that is required, the computing and the reconciliation of the income tax provision with the company's hypothetical tax provision, importance of a company's effective tax rate, and the interim period effective tax rate. So on the balance sheet, the ASC 740 requires public companies and privately held companies to classify all deferred tax assets and liabilities on their balance sheet as non-current. So remember that non-current means more than 12 months. The ASC 740 also mandates that companies disclose the components of the net deferred tax assets and liabilities reported in the balance sheet and total valuation allowance recognized for deferred tax assets. Now, most companies provide this information in a footnote to the financial statement. Public companies need to provide the approximate tax effect, while privately held companies only need to disclose the type of significant temporary difference. Here is an example of a footnote. They start with the company's income or loss, and then we get the provision or benefit, the current tax provision, and then the deferred tax expense. Then it lists the significant components of the company's deferred tax assets liabilities. It adds them all up, and then they get the net deferred tax liabilities. Finally, they take a look at their reconciliation items, like the tax-exempt income, the meals, the non-deductible life insurance premiums, and the dividends to reach the final income tax provision. Strangely enough, the ASC 740 does not define the term significant. However, public companies need to disclose separately components of its total deferred tax assets and liabilities that are 5% or more of the total balance. It also requires public companies to disclose the significant components of their income tax provisions in either the financial statement or note. Some components of the income tax provisions are current tax expense or benefit, deferred tax expense or benefit like we saw in the note, the benefit of operating loss carryovers, adjustments of deferred tax liabilities or assets for enacted changes in tax laws or notes, and then adjustments of beginning of the year balance of valuation because of a change in circumstance. Now on to computing and the reconciliation of the income tax provision. Now companies need to reconcile A, the reported income tax provision attributable to continuing operations with B, the amount of income tax expense that would result from applying its U.S. statutory tax rate to its pre-tax income or loss from continuous operations. Differences can arise from the following. Income taxes paid to a state or municipality increase the company's tax income provision over its hypothetical income tax expense. Income tax paid to a jurisdiction outside the U.S. can increase or decrease a company's total income tax provision over its hypothetical income tax expense. Favorable permanent differences decrease the company tax provision relative to the hypothetical income tax expense, and then unfavorable permanent differences increase the income tax provision relative to the hypothetical income tax expense. So here is an example of a computation, and before I continue, I need to say that companies can present the reconciliation in terms of a tax rate, as you see on the right, instead of a number. So you can see on the left, we have the US tax rate of 21% of their income. And then we have reconciling item of tax-exempt income, meals, non-deductible life insurance premiums, and dividends received deductions. And that gives us the income tax provision. On the right, we have the same numbers except they're a percentage. The ASC requires a publicly traded company to disclose the estimated amount and nature of each reconciling item that is greater or equal to 5% of the hypothetical provision. Now, that would be in this case anything that's over 64,000, and as you can see, none of them are over that amount. In fact, they're not even close. So technically, none of these items need to be disclosed separately. Now let's talk about the importance of the corporation's effective tax rate. The effective tax rate pretty much serves as a benchmark for companies in the same industry, and it tells you how other companies are doing. However, there are some non-recurring events or one-offs that can sometimes have a significant impact on the effective tax rate and throw off the whole calculation. Therefore, companies use the structural tax rate, which is pretty much the same as the effective tax rate, except it removes these non-occurring or non-recurring events and one-time events from the calculations to give a better look of how a company is doing. Analysts also compute the cash tax rate, which is the cash taxes paid divided by the pre-tax book income, and this is used to evaluate the company's tax efficiency. As you know, companies must report earnings on a quarterly basis, and they do so on Form 10-Q. Now, the ASC 740 states that at the end of each interim period, which is a quarter, the entity should make its best estimate of the effective tax rate and then apply that tax rate to the income reported in the quarterly statement. Now, this means that a company must reconsider its estimate of the annual rate each quarter, and when the estimate changes, they must adjust the tax provision for the year-to-date earnings. All right, so in conclusion, we learned today that the ASC 740 requires companies to disclose the components of the net deferred tax assets and liabilities supporting the balance sheet, and the total valuation allowance recognized for deferred tax assets. Public companies have to disclose the tax rate, while private companies only have to disclose the type of difference. The ASC 740 also requires companies to disclose the significant components of income tax provision. They need to reconcile the reported income tax provision attributable to continuing operations with the amount of income tax expense that will result from applying its U.S. statutory tax rate to its pre-tax income or loss from continuing operations. We also learned that the ASC 740 requires publicly traded companies to disclose the estimated amount and nature of each reconciling item which is greater than or equal to 5% of the hypothetical provision. The effective tax rate serves as a benchmark for companies in the same industries. Public corporations need to report their earnings on a quarterly basis. And then a company must reconsider its estimate of the annual rate each quarter and then apply that to the income and make any adjustments if necessary. With that, I want to thank you for listening to my presentation.